The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. Great to have you with us, and great to have my co-hosts, Phil Ordway and Elliot Turner. We have a great discussion ahead. Phil, over to you.
Thanks, John. I thought this week we'd talk about a paper that came out. Well, actually, I don't know when this was released. I forgot to look it up. I think it's pretty recent.
2010.
It was that long ago?
It sure was.
Oh, my goodness. All right. Well, I don't know why this came to my attention recently then, but that explains some of the mystery. Anyway, the paper is called Overconfidence, Underreaction, and Warren Buffett's Investments, which is obviously catnip. When I see a headline like that, you know that I'm going to download this paper and read it. So the parts that jumped out to me and the parts that I want your reaction to are twofold. So there were a couple of interesting parts. I guess I'll start with the good, and we'll circle back to the bad. So they actually looked at, they started with the 13F data in April of 1980 when it first became available, and went through the end of 2006. And there were a couple thousand observations in terms of individual stock positions each quarter in that sample set. So what would your guess be of the median holding period for an individual security? And again, I'm assuming that these data are correct. I did not go try to independently verify these the math here, but I'm assuming these professors did this correctly. And it seems to line up kind of with what I've observed over time, but I still thought the numbers were a little surprising. So let's play a little guessing game. What do you guys guess the median holding period would be?
I can't guess. I've got I read the paper and I have an
Oh, you read the paper already?
I cheated.
John, did you read it?
I did not read it, so I guess I can venture a guess.
You have to be the guinea pig on these three.
And before John guesses, I'll just say, Phil, when you tell me this paper is interesting and you give a title there, I'm going to go out and read it.
Yeah, fair enough.
So we're talking holding period.
Yeah, from I believe the first disclosure of the purchase to a complete exit. It doesn't actually define the holding period, but that would be my assumption.
Okay.
And I do think he adjusted for, they specified in the paper there are instances where Buffett was able to delay disclosure. So I think it adjusted for that. That's the one tweak.
Yeah, there were shockingly enough, there were 275 observations for which Berkshire asked for and received SEC approval for confidential treatment when they were building a position.
Okay, so I'm going to guess between 3 and 5 years.
Interestingly enough, it's just 1 year, which was a little bit lower. I would have guessed about 2 years. So how many of the stocks that are part of the sample size do you think were sold within 6 months? So first purchase to complete exit, I guess, would be the definition. What percentage of the stocks by number were sold inside of 6 months?
Probably more than half.
Yeah, about 30%. So we're kind of on both sides of it. And then there were actually only 20% of stocks by number held for more than 2 years. So I think the implication for me that does back up 100% with, the anecdotal evidence that we all know about and we all see every day is that he changes his mind quite quickly, and he is quite concentrated. So by the way, the number of the average number of holdings in the portfolio was 22 stocks in the equity book for the decade ended 1990. only 12 during the 1990s, and 33 from 2000 to 2006. And the weighting of the stocks as a percentage of the total balance sheet, the total value of Berkshire actually went down pretty sharply over that period of time, as we all know. But anyway, the point that jumps out here is that, for being such a long-term concentrated investor, which he undoubtedly is, and for good reason, the median holding period is still just 1 year. And there are plenty of cases where he buys something and then reverses course within, 180 days. I mean, that's not a long period. I don't think anyone would consider 2 quarters to be a particularly long holding period. But then of the 20% of stocks that are held for more than 2 years, which starts to get into a longer term horizon, of course, what goes unsaid here is that the dollar weighting of those 20% of stocks is enormous, right? Because the really, really big giant winners are allowed to run and run and run for years and decades, right? I mean, the really big outsized winners that, started with things like American Express, you go into Coke, you go into now Apple, things that have, are probably going to be measured on average with a holding period of 1 to 2 decades, not 1 to 2 quarters or 1 to 2 years. So I think that's a really important point that most people might kind of think about, but it goes a little bit unsaid. I mean, the part that starts to blow my mind, though, is in talking about all this kind of stuff, the supposed overconfidence, which we'll circle back to, and now the concentration, which the authors at one breath call it highly concentrated, and in the next sentence refer to as under-diversified. So they said, quote, "The apparent under-diversification is consistent with the presumption of an information advantage." And they refer to this over and over again as an information advantage and having superior information and private information. And again, these terms are not defined, but I think, they're well known enough that we can all presume to have the same understanding of what the authors mean. And I find it truly bizarre because I think in every single case of these, the big investments that matter, and even the small ones that don't really matter, there's absolutely no inside information. There's no private information. There's no superior information. There's certainly superior analysis. There's superior discipline. There's an intensely different level of approach. But to call it superior information and private information is just really bizarre and not true. Did you get that read from it, Elliot, when you went through it?
Yeah, it's so awesome that you picked up on this, because one of the things I wrote down to speak about was how bizarre that was, especially considering they talk about investors could have followed Buffett and didn't. And
Right.
These analysts who downgraded the stock were exhibiting overconfidence. And I'm like, the clearest explanation for Buffett's edge is actually behavioral or time horizon. It is not information.
Right.
Because in some instances, the stocks underperformed over shorter periods of time, which is when you'd expect an information edge to manifest. And, the farther you go out, the less an information edge matters. Like information today could make 5 years down the line returns happen.
No,
it was nonsense. I got mad about that.
I did too. I'm glad I wasn't the only one then. And I'm getting a little ahead of myself because, the point of the paper is right here in this second sentence of the abstract. The market seems to underreact to the revelation of Buffett's trades. And it goes on to say that, from the sample period of 1980 through 2006, it was possible to achieve investment results similar to Buffett's own simply by following his trades as disclosed through Berkshire Hathaway. And again, the presumption here is that, okay, he's pretty good. Like they admit that he's a, quote, superior stock picker, however they framed it. And that the chances of this being all luck over the entire duration of the sample period is less than 1%. At one point, I think they even assigned it like somewhere between 1 basis point and 64 basis points as the percent chance of this being all luck attributable to Buffett, which is mind-boggling and hysterical that they put a number on it that precise using a Monte Carlo simulation, but I digress. Anyway, the point that I think really bothers the authors is that they say an efficient market in the semi-strong form would quickly drive equilibrium prices to reflect the information content of such disclosures, implying that no further benefit should be in the offing. And So their leap to conclusion here is that because there's a lot of other evidence for overconfidence, which there for sure is, and we'll come back to that. Overconfidence is a huge deal, and that's why I was so excited to read this paper. But they take the exact wrong conclusion from this, which is that because the market underreacts supposedly on the day or the week or the month of the disclosure of these trades, that demonstrates overconfidence. And the evidence that they purport to put forward for all this is really thin and bizarre and completely lacking, in my opinion. And I just found the whole thing really, really strange. I mean, they say, what is unexplained is the underreaction. As an explanation that we pursue in this study is overconfidence on the part of market participants, such as analysts and institutional fund managers, blah, blah, blah. And because there's lots of other evidence for overconfidence, they just seem to tie it all back to this but there's no there, right? I mean, did I miss some sort of grand revelation here, Elliot, that was hiding?
No, and I similarly thought that was bizarre. I felt it was more an inclination, and to me, it all came down to time frame. To take a quick pop and say I'm out because that's not fundamental. Not
right.
So much an overconfidence that they knew more than Buffett, because on the revelation that Buffett has a position, often those stocks will rise, sometimes considerably in the short term. So if you believed it was worth, like 115 and it was trading at 100 and it's suddenly at 115, then shouldn't you move to the side? That's not overconfidence.
Yeah, believe me, I know. So, I mean, to further this point, there's a section on page 8 where they go into one of, I think, the most bizarre parts of a very bizarre argument about insider trading and executives' decisions. And so they cite some other paper that says that they found evidence that links insiders' option exercises and selling decisions to private information. And I will admit I didn't actually read that paper, but I'm going to go out on a limb and say that, yeah, that's probably legit. Like, executive directors and officers of a company certainly do have private inside information, as you would certainly hope they do, running the company. And that information very legitimately informs their decision as to exercise options or sell stock in their own company. So I'm on board with all that, but it says, and I quote, "Since it is likely that private information of insiders overlaps with that of Buffett when Berkshire Hathaway has a position in stocks of their companies, then these trades are most likely to follow Buffett's lead, albeit with little effect on market prices given the relatively small scale of such trading activity. We further note that to the extent insiders share the same private information as Buffett with respect to their firms, overconfidence in the form of overweighting private information could conceivably add to the prospect of insiders appearing to mimic his trades." Like, I don't even understand what they're trying to argue here. Like, that just doesn't make any sense.
Nope. Yeah, that was definitely bizarre. I think part of the problem, one of the things I was thinking as I was reading this is, okay, there's some really interesting takeaways, but there's a fundamental problem with applying Fama French models to try to explain Buffett, because you end up like with these mental gymnastics of backing into reasonings like you're talking about right now.
Oh yeah,
that was my explanation for it. I could go. Keep going. I'll throw out some other things after.
To give you another example of the type of thing where this is just a complete fish out of water. And again, I'm not trying to disparage the authors. I have no idea who they are, or I briefly looked up their backgrounds, but it doesn't really matter. But this is just a unintentionally hilarious example of an academic style paper trying to pound a square peg into a round hole. Like, it's really bizarre. There's a line at the end of page 13 that says they're looking at the performance of Berkshire Hathaway as a whole, kind of benchmarking it to the market and comparing its, quote, abnormal return. In other words, the excess return, the evidence of outperformance here. And they wrote, "We also note a drop in the significance level for Jensen's alpha due to the higher volatility of Berkshire Hathaway's stock compared to that of its asset portfolio." And it's like, I don't even know where to start with this. Like, if that's really the kind of thing that they're studying and looking at, I think they've already missed the boat to begin with, right? There doesn't seem to be much there. But to your point, going back a page, using Fama and French's industry classifications, they note that Berkshire's portfolio is tilted toward a couple of industries, but they again cite the fact that this under diversification is consistent with the presumption of an information advantage, but it's limited to Buffett's circle of competence. And they're using his own term, right? So they've clearly done at least some reading and reference here, but it just completely misses the point. And so this is where I want to get into some of the takeaways that I had from it, which is that investor overconfidence and executive overconfidence, which they acknowledge in here outside of the realm of exercising options and selling stock, that executive overconfidence might be better limited to an analysis of operating decisions, right? Should I pursue this acquisition? Should I build this new factory? Should I explore this new strategy, et cetera, where there is undoubtedly good evidence of overconfidence among executives there. And likewise, investor overconfidence is very real and it's very problematic. And there's tons of evidence for it. I mean, the constant activity and constant churning of everyday investors, retail investors, professional investors, active management writ large is an everyday real life laboratory that is evidence of investor overconfidence, because every time you buy or sell, if it's going to work in your advantage, you have to be right and the other side has to be wrong, or you have to have some sort of edge, some sort of time horizon that gives you advantage, something. And if you're making trades every day or dozens of trades every day, week, month, whatever the case may be, you're more than likely exhibiting some degree of overconfidence for the vast majority of people. But that didn't come up in this paper, and that was really disappointing to me. I mean, I think it just misses the entire point of the strategy. I mean, at one point they cited that because analysts are often downgrading the stock as Buffett is buying it, and because institutional investors are often downgrading the stock when Buffett's buying it, that somehow bolsters their point. Again, like I read it 2 and 3 times. I couldn't quite figure out how it was written and what the point exactly they were trying to make was. But that is exactly Buffett's point. It's like he wants to be buying something when it's getting cheaper and when other people are selling it and when sell-side analysts are downgrading it. Like that doesn't have anything to do with anyone else's overconfidence or Buffett's overconfidence. It has everything to do with Buffett's superior analysis and his different and better holding period and different
and his behavioral edge.
Exactly, his behavioral edge and his different and better liability structure, right? Because he can hold these assets over periods of time when other people feel that they can't. So I just thought it was a very loosely written argument and very strange and very different. And the other, and different in not a good way. The other argument I want to make beyond the overconfidence issue, which you guys can chime in on and come back to, is that there is this implicit argument in the paper that all you had to do was buy these stocks like the minute or the day or even the week, I think, that Berkshire files its 13F. And, we've seen this argument a lot out there. And I think
that wasn't an argument. That was the study, right? That was their point. They studied the results and it said it had something like 5% alpha.
Sure. And that's probably, again, I'm not disputing the math. I haven't done the math to value. I mean, I would probably have some quibbles with how exactly they were calculating the excess.
Yeah, they
return.
weren't purely measuring alpha versus the S&P. It was like a factor based.
It was a factor based thing, and right. So I would probably have some issues with that. But the point is, you're right. Like I have a huge issue with the conclusion of the paper being that the market underreacts to Berkshire's disclosures of new positions, and all you had to do, you idiots, is go out and buy exactly what Buffett does when he buys it, and you're going to get the same results. Like nothing could be further from the truth, right? There are basically
they didn't say the same results. They said you could get much better results than the S&P.
Fine.
Important qualification, though.
I don't know. At one point, let me see. I thought they said I did make the quote.
They said it was close to the same results.
Yeah, fine.
Which very well might be true. Because most of the return's driven by the longer term holdings anyway.
100%, but I'll have to find the exact quote. But yeah, the point is that if you were to do that mechanically, right, and you had the exact same liability structure as Berkshire did, the same quality, quantity, and duration of capital at Berkshire, and you were going to somehow tie yourself to the mast to resist the siren song of selling at the worst possible times, then yes, of course, you could generate whatever the returns on paper said they were going to be. But nobody has that. Nobody has that discipline. Nobody has that behavioral edge. Nobody has that temperament. Nobody has that capital. And so this is to me kind of a self-defeating argument. And in a broader sense, I've always had a big issue with the notion of cloning someone else's results. And by cloning, I mean like exactly mimicking their results. I have absolutely no problem. I think it makes all the sense in the world to say, okay, Buffett or whomever is a great investor. I respect the process that's going on over there. They do good work. I'm going to look at what they're buying and selling and see if that can inform something that I'm trying to do within my own capabilities, within my own capital, within my own circle of competence, et cetera, right? Great. That makes total sense. But if you're going to literally clone someone else, and clone means to take something and biologically replicate it, right? I think that's the worst possible idea, because you have not done the work. You are not going to have the conviction. You are not going to have the same temperament. You are not going to have the same behavioral advantages. You are not going to have the same analytical insights, and you are not going to have the same conviction to hold on or buy more when things get ugly. And you sure as heck aren't going to have the same capital and the same quality and duration of capital that Berkshire has. Right. So why is this notion of like, oh, we should just copy Buffett or copy everybody and do it the exact same way? Like, you should be trying to copy the elements of his process and his structure that work for you. And you should be trying to seek what he sought when he was trying to become the best investor who ever lived, not trying to just blatantly copy him and clone him. Does that make sense?
Yeah, we've talked about this a decent amount. You can't outsource conviction. You can't just Munger has said explicitly, like if you want to be the best investor, you have to find what works for you. I obviously did not quote that exactly right, but I think everyone has to find what works for them in markets, find what fits their personality, find what has some sort of like fundamental rationale. So there's plenty you could learn from Buffett on that front. But if you merely wanted to just buy what Buffett buys, you should just buy shares of Berkshire and go to sleep easy every night.
Well, that's a great point. Simple. I mean, if you really want to do this, you're right. I mean, that goes unaddressed in the paper, but yeah, that's certainly a decent option, is to just buy Berkshire and express.
I was wondering, one of the notes I wrote to myself reading this thing was maybe a lot of these people institutional investors who are selling it at the time of Buffett's disclosure actually own shares in Berkshire, and they're like, I don't need to own this twice.
Well, I suppose that's one explanation, although I kind of doubt it. I think the ownership of Berkshire in that crowd is probably a little bit thinner than it should be, but who knows? I have no idea what the numbers would look like on that.
So I had a few things here. I picked up on a couple weird things, but maybe some bigger ones. One of the weird ones I thought is interesting, and maybe it's something to think about. They said if there was one factor they could identify which was deterministic of Buffett's returns, it's that he under-indexed. He essentially avoided entirely firms with high asset growth. And I thought that was a really interesting point, because that could cover growth as a space where you didn't go into high growth, but also like capital intensive firms who might be in the wrong phase of a capital cycle. And I thought that was a pretty powerful point. I kind of looked at a bunch of companies that had a rough couple of years. High asset growth is definitely one of the hallmarks of some of those situations. So I thought that was like an interesting throwaway line that maybe had a lot of value behind it, incidentally enough.
Agreed.
I spent a lot of time looking at the industry chart. I thought that was so interesting. It was in the appendices of the paper.
Yep.
And I think there were a couple notable takeaways I had, which is, there's obviously a lot of persistence, but there's some interesting evolution over the years. So like railroad and transport were like the least owned, and the second least owned. And we know what he thinks of railroads now, right? It's a core piece of the permanent portfolio. And chemicals was the least owned. And he's actually invested, I'd say, a decent amount of capital in chemicals over the last decade, with the Lubrizol acquisition and a couple of public holdings that he's gone in and out of, in consumer/technology, where consumer was almost non-existent, technology was non-existent. If you look at their portfolio today, I mean, Apple, you could call a consumer company or a technology company, but man, it's pretty important. And there's plenty of technology beneath it, and there's a consumer staple beneath it. So I thought that was pretty interesting. And then, we're recording this on April 13th. Buffett spent 3 hours on CNBC yesterday. And the paper, numerous points emphasizes, and in this appendix, it's very clear, banking was his most preferred sector. And I don't know the exact quote from yesterday because I can't get the CNBC Pro interview, but he basically said banking is a pretty bad investment, and he only owns Bank of America these days. When he was asked why, he's like, I like Brian Moynihan, was the impression I got from the version I saw.
That's pretty much what he said. Yeah.
Yeah. So, I mean, that was by far his most prominent sector that he invested in, according to this paper and the way they determine sectors. And I thought that was a pretty interesting change. And then, this holding period thing, I was like, wow, 1 year. God, 1 year. Only 20% of the stocks were held for more than 2 years. That was mind-blowing to me. And, I was reflecting on this. One other thing from yesterday's appearance was that Taiwan Semi, he sold Taiwan Semi very fast. I think that was like a 6-month holding period.
It had to be right around there, yeah.
Yeah, and he said he sold it because of geopolitical fears. Personally, I think that's nonsense, because there's no reason to have been incrementally more fearful of the geopolitical environment with respect to Taiwan Semi at the date he sold it versus when he bought it. In fact, one could make the case that you could have had more fear at around the time he bought the stake. Let's leave that aside. It was a really quick gain. I think he's very willing to be Mr. Market's business partner. And it's one of the things I feel I have to get better at myself. But there's a very big difference. And this is what I was saying to myself. There's a very big difference between thinking long-term and holding long-term. It's more important to think long-term than force yourself to hold long-term. This is me editorializing here. This is something that I was thinking as I was looking at these numbers. Buffett's been very willing to trade in and out of positions. In fact, one of the bizarre semantic choices that this paper made was to call him a trader at numerous junctures. I think he'd, vomited his mouth at the thought. But one could think long-term, but you need not hold long-term. He got a really good gain in Taiwan Semi pretty fast. So why not leave? Maybe he was expecting that kind of gain over like 2 years. I don't know the answer. Geopolitics might be just something to wave his hand and give, something to Becky Quick to have a headline about. But I thought that was really interesting. Thinking long-term versus holding long-term.
So I'll jump in because you raised 2 or 3 excellent points there. I will say that I think the point about high asset growth is enormous. And I think I think it was AQR and Cliff Asness and colleagues who wrote a paper about, if you had to really dumb this down into one factor, it was the lack of change, right? Like quote unquote high quality. And so you're right. And Buffett has qualitatively described this as a search for good businesses that won't change, right? So I think by definition, a business that's undergoing really, really rapid asset growth, or any kind of growth, but as demonstrated by asset growth, is in an industry and in a business that is subject to high rates of change. And I think the base rate for businesses that A, are in industries undergoing high rates of change, and B, have to fund really rapid asset growth, I bet those base rates are pretty poor relative to the things he thinks he can find and execute on. So that's point number 1, which I agree is like a throwaway line that was worth the price of admission, so to speak, of this paper. 2, on Taiwan Semiconductor, I actually disagree. I'll take the other side of that, because I'm pretty sure that in the holding period, the brief holding period that he owned Taiwan Semi, was Nancy Pelosi's visit to Taiwan, lots of very aggressive war games, including the response to her visit to Taiwan. I don't think geopolitics is a throwaway kind of CYA excuse at all in this case. I think it's really scary. I think it really portends big, important things for the world as to what that means. I mean, could Buffett be wrong? Absolutely. Of course he could. But I think what he's doing is saying, a 1% chance of a zero is not worth it, right? Because anything's times zero is zero. And look, I mean, when and if Taiwan is invaded, Taiwan Semiconductor's Western shareholders are probably not going to have a great day. So
sure, I meant that more in terms of like, I think the quarter in which he purchased the stake was when Russia invaded Ukraine.
Right. I agree, but that was a different
I'm just saying arguably, not necessarily the case, but I don't buy the case to be that much more concerned about it 6 months later that you'd be a seller of something that you bought before. Like, I don't necessarily think the heat was all that different. It was a concern at that time. I think, it was raised by a lot of analysts at the time that it was definitely one of the bigger risks there.
It was, but I think the evidence just became so much clearer over the ensuing months that this bolstered China's case in their own mind. And that this, and look, I think another thing worth considering is that, this is not the kind of decision that he tends to react to in a day, right? I mean, I distinctly remember it in the case of the airlines with COVID, right? Where you could argue whether he was right or wrong or somewhere in between to sell the airline stocks in April of 2020. But he sold them in April of 2020, not March of 2020, and certainly not February of 2020, right? So that he tends to be extremely thoughtful and deliberate. And so, yes, even though by almost anyone else's standards, he's acting quickly and acting with big conviction and in big size. But, as the evidence comes in, he's definitely the type to quote unquote sleep on it, right? He's going to think about it for probably something more like weeks or months rather than hours or days. So in my opinion, I think it was probably sensible and likely that he just digested the developments as 2022 unfolded as it pertained to Taiwan and reevaluated the risk in owning that investment.
Yeah, no, that's fair. I was just, I guess as far as I see it, it's hard to imagine I don't know. I could go on and on about that, but
we can argue.
There were some people that were saying that like Russia's invasion was a test run for what China's ambitions were in Thailand and in Taiwan, and that the lack of quick success for Russia may have cooled China to thinking about an invasion, because it's a lot harder than you'd think, even in a case where Putin was like, "We'll get this done in 3 days." So right. I just think you can make both cases. It just seems like a cop out of an explanation.
But even in there, you had Xi Jinping, cementing his leadership basically forever, and lots of other things happening. So I don't know. Again, it's an interesting debate where we can't ever prove the counterfactual. So whatever.
But the amazing part about it is that he changed his mind so quickly on the position anyway, that he's willing to just say like,
right.
And it could be because it was up so much, but he's like, peace out. I'm moving on to my next.
And so that's a great point, and something that I'd love to test in an alternate universe is, and one of the great tests of an investor, in my opinion, is, in this case, it probably made it easier. At least it would have made it easier for most people to say, all right, this situation's gotten worse, in my opinion, and I'm showing a gain on it. So I'm just going to take this gain and move on to the next thing that's easier and better and safer and more reliable. It would have been really interesting to test it in a parallel universe where, for whatever reason, the stock was way down from where he bought it, because 99% of people, in my opinion, would be more likely to hang on and try to get back to break even or something, or save some face, so to speak, if they were underwater on that investment rather than sell it in the face of the exact same evidence, right? And I don't think he's one of them. I think that's what makes him so great, and it's what makes a lot of the greats so great, is that they're willing to do the right thing regardless of the prior actions, the commitment bias that might be in place, the sunk costs that have already been expended, the losses they're showing on paper that are now about to be realized. And I think it would have been fascinating. But you're right. I mean, to me, the best takeaway from this is just re-emphasizing the point that you have to constantly be turning over rocks to find that handful of big winners. And I think it was this year's shareholder letter, right, where he said, an investment every other year, a couple per decade, was in the entirety of his performance record, right? The entirety of his success was those relatively small handful of decisions every 10 years. But there were dozens and hundreds of tiny little decisions that just didn't work out and didn't become consequential over that period. And so it wasn't like he was sitting there completely inactive. It wasn't like he was sitting there just waiting for that one thing to come along. But when it did come along, he seized on it. And when it was clear that it wasn't the big one, it wasn't working out. I mean, think about something like IBM, right? I mean, IBM could have turned into Apple, but it sure as heck didn't. And he moved on, right? Or he owned Wells Fargo forever and he moved on. And that's the key takeaway for me, is that you have to have this really good mix between behavior, temperament, holding period, rational analysis, probability weighting of opportunities, and marrying that all up into the bigger portfolio. It's just such a fascinating dance.
Absolutely. And, I'll say this for myself again, just to kind of beat the point into my own brain, but I think it's worth saying also, I think a lot of us who want to be like great long-term oriented investors think that means we just, buy and then don't sell.
Exactly. And that's just not true. Yeah.
Just not true at all. And that's such a good contrast between IBM and Apple, right? He bought both. And Apple, to that point about one investment a decade, that was the special one, right? That generated, maybe the banks in the beginning of the last decade were an important source of return, some of those pref deals. But Apple, on a cumulative dollar basis, did way more than the combined investment in the banks during the financial crisis.
Yep.
And it's fascinating to think about. I think a lot of people put too much pressure on being right on everything. But, one or two big things that you get right could make up for a lot of mistakes along the way.
Yeah, it's such a fascinating example of like the advantage that public markets have over private ones, which is, as an investor, it's such a more frictionless, efficient way to allocate capital between opportunities, where for, next to nothing or very, very low transaction costs, you can kind of patiently turn over rocks until you find great opportunities. And when you realize you're wrong or when conditions change, you can reverse course and get out of your mistake relatively easily, right? And it's such a beautiful overlooked advantage that it's worth reiterating it here, I think.
Yeah, agreed. I think that was like perhaps I'm glad you latched onto it right away with asking us the question. I'm sorry I couldn't make the quiz a little more fun in guessing myself. Just let it be known, my guess would have been 5 years. So
yeah, my guess was going to be higher than 1 year as the median holding period for sure. And I think that's why it's worth reiterating that, the lion's share of the capital certainly was in that 20% of stocks that were held more than 2 years. But in terms of the number of stocks and the, what's going on, if you just rank them by, each stock it gets an equal weighting. Yeah, it's pretty clear, right? I mean, it's only a year and there's quite a bit of turnover at the low end.
Yeah, and it made me wonder if we can't prove it at all. I wonder if there's any single instance of Buffett having bought a stock and reversed on it before having ever had to file a 13F.
Well, I bet there are. Security. Yeah, that's a fascinating question, but I would think there has to be plenty of that going on, right?
Yeah, that's really interesting. And it's something I need to think about for myself, because I've had this like disinclination to act. And I had this rule, which I've actually killed for myself, that was, I do not judge an investment within the first year of making it. Wait to see whether the information demonstrates whether I'm right or not. And, I for several reasons have abandoned that, but hey, if Buffett could do it, hell, I should be too.
Yeah,
not to say that I could do anything right in the way that Buffett does, but
sure.
It means that why should that be, a sacred cow that all of us who aspire to be long-term investors hold out there?
Right. Yeah, it's a great point. And again, I have no evidence for this, but my guess is it's not happening every quarter or even every year where something is bought and completely 180'd and sold before it's ever filed in a 13F. But I bet it happens multiple times per decade would be my guess, right? Just by the nature of it. And certainly in my case, to your point, Elliot, yeah, I mean, I'm trying to say, all right, I'm looking at the business over a 3 to 5 year time horizon, right? I think beyond 5 years, that's the hope, right? Is I certainly want to have confidence that the business will still exist and still be prospering at some level 5 to 10 years out. But like, I can't get too specific, right? The base rate of any forecast at my level is going to be, pretty broad. Like the base rate of accuracy is going to be low. The forecast itself is going to have to be pretty broad beyond that. So you're right. Like, why should I be completely reevaluating things inside of, say, 6 months, right? Like, what is 2 quarters, 180 days going to really teach me about anything? But there have been a handful of cases where, in the last 10 years, call it, where I've reversed course inside of, 3 to 6 months. And there are definitely a couple of other cases where I should have, right? So that's the bigger lesson to me is that I absolutely should have been taking a more self-critical look at decisions I just made, and where I probably had enough evidence and enough contrary evidence to say this isn't going how I planned. This isn't what I thought I was doing. I was wrong. Conditions have changed, et cetera, et cetera. And even though it's only been, 14 weeks or 7 months or whatever, who cares what sort of arbitrary time horizon it's been since I was buying this thing? I need to turn tail and go the other way.
Do you know of any examples where Buffett disclosed a holding in something, sold it pretty quickly, and then bought it back later in a more meaningful way for a successful investment?
Well, I'm pretty sure he's done it with Disney, right? Because he got shares via Cap Cities and then sold them. But I think he bought Disney shares back again years later and then sold them again. So I guess that would sort of count, right? I mean, there was an acquisition involved, so it's a little bit different, right? Because it wasn't exclusively his decision the first time. But, I think he's spoken about it and said, even though my reasoning for it was pretty legitimate, I was basically wrong, and I would have been better off just sitting on these Disney shares for all these years, right? And he talks about, I think it was in the late 1950s, I guess, maybe the mid 1950s, when he had lunch in California with Walt Disney himself, and he's like, I was super impressed. He's one of the best business people I've ever met in my life. And all I had to do was go out and buy some Disney shares that day and sit on them. It would have been amazing, right? And he's obviously correct about that. But yeah, I'm trying to think of other examples of something where he's bought something, sold it, and then bought it back. I can't think of too many off the top of my head.
Yeah, because I would think there's tremendous value in longevity, whereby you have experience with something, know it really well. And I know he's cited longevity as a source of what got him into several different investments, having read their annual reports for decades, knowing it really well, being ready to act when the time to act came about. But sometimes, I don't know, I was just thinking more for myself, there are situations where you could leave something aside and be in better position if and when the right opportunity arises. If you're just not thinking about it the right way at the time you buy it, to leave quickly.
And to your point, a related question, which is an interesting one, is, he was willing to sell Disney. He was willing to sell Wells Fargo. And those were kind of, I guess, somewhat similar investments in both size and importance and holding period of, I guess Wells Fargo was probably held for longer, but he was willing to sell IBM, but he was not willing to sell Coke, right? Which he's talked about. It got pretty expensive for a while there after he owned it, and the returns to holding it were pretty poor. And he talked yesterday, to your point earlier, Elliot, about holding on to B of A, which he still does, which is a very big position for him and very important. And will there become a point where he would have wished he had sold B of A or sold more Apple or whatever the case may be? And it gets tough because when you're this big in the stock, it's not so easy. I mean, you want to talk about underreacting to these filings and these disclosures. I mean, it still does matter when it's known that Buffett's out there selling it. I mean, it's tricky, right? It takes quite a long time to unwind a position of that size in the market. So it's not all that easy. And it would be interesting to see that done in a parallel universe too.
It would be interesting to see the study in reverse. Like, how do securities that Buffett sells perform over the next 6 months, 12 months, 3 years, whatever?
Yeah. My guess is that would be an interesting study. And my guess is that they would be average to slightly below average, compared however you would do it to the S&P 500 or whatever. And yeah, actually, to your point, Elliot, about yesterday, it's worth watching those clips of that interview in Japan if you can. I think it also it's an interesting commentary that he actually went all the way over to Japan, right? I mean, he very, very rarely travels internationally for long periods of time like that. So I think, and particularly at this stage, right? I mean, he's not, I don't think he's flying and traveling anywhere near as much as he did 10 or 20 years ago. And to go all the way to Japan is a very big statement, I think, in my opinion. And so that's point number one. Point number two is he did talk a little bit about the banks. And, this goes back to what we talked about a few weeks ago, which is, and again, this is not any sort of specific investment advice by any means, but in basically every bank that I've looked at, everyone kind of assumed coming into this last call it 2 years, that when rates eventually went up, it was going to be just a great time for the banking industry, because rates had been so low for so long. It was just really hard to earn a good spread. And if rates would finally revert to quote unquote normal, salad days would come again for all the banks. And so the problem, of course, is that the rates have shot up in the last, 18 months, call it. And not only do banks have this issue of, large unrealized losses in their held to maturity investment portfolios, which is fine. I mean, they're big losses, and in almost all cases, they're going to be weathered, and they will actually be held to maturity, and they won't represent any sort of permanent loss of capital. They are going to represent a significant drag on the bank's income statement for sure over that period of time. And they were certainly a suboptimal allocation of capital with perfect hindsight. I mean, it was just not a great idea. And this isn't just 2020 Monday morning quarterback. I mean, it was just not a great idea to take on a lot of duration in 2020, 2021, early 2022. It was just the wrong time to do it. And not every bank did, but those that did are suffering the consequences. So I think that was kind of point number one that he was making between the lines. Point number two, which, he also kind of got to a little bit obliquely, or maybe this is just my interpretation, is that, look, a lot of banks benefited for so long from having very low deposit betas, meaning the deposit rate they were paying changed very slowly relative to the interest rate environment. And so a lot of banks got away for a very long time with people and companies saying, well, I have all this money sitting in cash earning something close to zero, but screw it. Like, I don't care. Rates are really low. Everybody's in the same boat. Like, who cares? Now that rates have shot up, now that things like Silicon Valley Bank have happened and highlighted this whole problem, in my opinion, that's going to change. And a lot more people are going to be putting a lot more money into money market funds or T-bills or whatever, and taking it out of these beautiful low-cost deposit accounts that the banks have been benefiting from for a long period of time. So that's by definition going to squeeze their net interest margin. And then you throw in on top of it, just good old-fashioned things like a credit cycle that I'm not predicting a recession. I have no comment on our odds for a recession. I don't have much confidence in my own predictions there anyway. But if and when we get a credit cycle and have to take a lot of provisions to deal with bad loans and bad credits as they come up, that's not going to be a lot of fun either. So I think no matter whether I'm right or wrong about that analysis, and right or wrong in kind of paraphrasing what he was trying to say yesterday about banks and his comments about B of A, I mean, the proof is in the pudding, right? Because he didn't allocate any capital of any size in recent days to the opportunity that would have been there.
As far as we know, I'd imagine that.
Yeah, I agree. I mean, I guess you could find out in the 13F that he was doing something in March, but I think he would have been less equivocal yesterday if that were the case.
Yeah, I said that largely in jest, but
right.
Yeah, no, it was interesting to hear him speak so bluntly about that. And, I think it's just interesting to think about the evolution of what is and is not within a circle of competence, and what is and is not investable over time. I think there are definitely some rigidities with which people impose on themselves because Buffett did as much. And yet there's, some degree to which slowly but surely you can broaden your horizons. You could broaden your competencies. You could broaden your, or forget about broadening. You could see fundamental change happen in a given area. And perhaps those are some of the most profound investment opportunities. Like Apple absolutely would have been uninvestable to Buffett for a long time. And just the kind of actualization of it becoming investable might have been the sign that there were good returns to be had. The counterpoint to myself in that is the contrast you made with IBM, right? That was not a good time to invest in, time or place to invest in tech. Well, it was a good time and place to invest in technology. IBM was not the
just
place
not
to
IBM
put those chips. Yeah,
exactly. Yep, I think IBM was just kind of its own thing, but
yeah, he followed it long enough. But yeah, probably was.
Yeah. Well, that's all I had on it. John, do you have any closing thoughts or comments on the mess we've created here?
Well, I guess just one observation on the Buffett comment. Was there anything he actually sold and then bought back? I wonder if Oxy would qualify for that.
So are you saying because he bought the he bought common, sold, bought the preferreds, and then rolled that into common and has been buying a ton since. Is that the sequence? I'm not too close to it.
I thought there were also some sales along the way, but maybe not the whole position. But I do think he did trim it at some point. I'm not sure though.
Was it before they came to him looking for his support for the acquisition they were doing, or is that unrelated? Because
I want to say it was in 2020 that he was trimming, but maybe I don't remember that correctly. But
yeah,
I do feel like he's been pretty flexible on the oil and gas thesis, where basically he wasn't really excited about it, but recently seems to have committed quite a bit of capital to that.
Yeah.
And to the point I was trying to see if it was there, I mean, the situation changed dramatically from where things were in 2020 to where things were in the beginning of this year when he started buying Oxy every day, basically.
Yeah, exactly. And I think just going back to your point on Taiwan semi, I think both of you guys, make great points on that. And sometimes I feel like it can also just be the facts may not have changed, but one's assessment of the facts changes, or one becomes a little more risk aware. I know that happens to me a lot. Especially if a position grows in size, I tend to really internalize the risks a lot more. And even if no new information comes out, you may just kind of decide that there is a risk that didn't seem like a big deal, but over time you just assess it differently.
Yeah, I agree.
Makes a lot of sense. Definitely fair.
Great. Well, I don't really have much to say on that paper beyond what you guys already said. I think it's pretty self-explanatory, and I think the paper has a lot of problems with it. So I think we'll just.
It did. There were just some interesting nuggets in there too. It wasn't all bad. It was definitely worth a skim, despite some real head scratchers in there for sure.
Yeah, definitely.
I'm going to dwell on the holding period and the asset growth points, because I mean those are fascinating to me. I think, I don't know, I'd love to hear from some of you listeners and on Twitter or an email, what you would have guessed the average holding period is or was. I'd imagine most people would guess a lot longer than 1 year.
Yeah,
I agree.
Yeah, and maybe that is the most interesting, actually, takeaway for those of us who kind of, associate Buffett with long-term investing, and that association is not out of place. But even so, there's nothing wrong with getting out of positions quickly. And I think that's just something that everyone should be aware of. Especially if you find that you made a mistake, why hold on to something just to fulfill some kind of artificial holding period?
100%.
Yeah.
Yep.
Great. Well, thank you so much, guys, for another great discussion, and thanks everyone for listening. Goodbye for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.